Welcome to this video on the long put strategy. Similar to the long call strategy, this strategy provides a simple approach to entering the options world. If you've ever shorted a stock in an equities position, this strategy is the method used in options to conduct a similar trade. Let's discuss this simple play. The long put strategy falls under the umbrella of directional plays. If you believe a stock will sell off, this strategy is well suited for that. Not to be confused with taking a long position in equities, a long put simply means you are buying a put expecting a move lower. The beauty of the long put lies in its limited risk, while having a potential reward that is virtually unlimited, promising significant returns when executed correctly. Now that we have an overview of the long put, let's explore some key fundamentals. This approach entails acquiring puts with an anticipation of a bearish move lower. It involves a single leg option play, meaning the option contract is bought as a standalone position, without combining it with another option in a complex or multi-leg strategy. For a single leg play, it is most effective during breakdowns and downtrends, such as range breaks, breaks of key support levels, channel breaks, ABCD patterns, and more. With single leg directional plays, we need movement. When selecting your strike price, consider going at the money or slightly out of the money, usually 1 to 2 strikes away. It's important to note that choosing a strike price that the underlying asset has a chance of moving to and through prior to expiration is ideal. For day trades, implied volatility, or IV, is less critical since you'll be closing the contracts the same day, but keep a close eye on theta decay as you approach expiration. For swing trades, opt to buy when IV is low, and while theta decay is something to consider, it becomes less critical compared to day trades, as these trades typically have expiration dates further out in time. Now let's discuss the risk, reward, and the break-even point associated with the long put strategy. Understanding these elements is crucial for effective risk management and maximizing potential gains. The risk is straightforward. It's the amount paid for the contract. For instance, if you pay $100 for the contract, that is the most that you can lose, setting a clear boundary on potential losses. Alternatively, the reward can be unlimited, offering room for substantial gains. Calculating the break-even point is equally vital for understanding how far a contract needs to move to provide a return. The break-even is the difference between the strike price and the amount paid for the contract. Let's break it down with an example. Imagine you purchase a put with a strike price of $100 and a premium of $3. On the day of expiration, the stock would need to close at $97 for you to at minimum break even on the position. Moving to or past this price prior to expiration would increase your return. Let's take a look at an example and how we could have implemented a long put strategy on this weekly chart of PFE. In the first scenario, observe the overall downtrend. Notice the area of previous resistance around $55. On this week, PFE pulled back to its resistance area, failed to move higher, and resumed trading below the 50 moving average. This combination signals potential downward momentum, moving back into the downtrend, making it an appealing entry point for a long put position, targeting the previous support area near VWAP, also known as the volume-weighted average price. Should you have missed a failed breakout with a move lower, a second scenario presents itself later as it fails to hold VWAP. Your target will always depend on your strategy and risk tolerance, but keep an eye out for areas of support where price may stall or bounce. Should your contracts be approaching expiration, be sure to manage your position, as the long put strategy is directional and requires the market to continue moving to increase profitability. Considering what we've learned about the break-even point of the long put, if you took the second trading opportunity and purchased puts as PFE broke below VWAP, at a strike price of $42 and a premium of $2, PFE would need to close at a minimum of $40 at expiration for you to break even on the position. A move to and past this price point at a faster rate would increase the return on the position. Keep these factors in mind as you decide how long the move will take and how much room the position has for it to move, which will help you to choose the right strike price and an appropriate expiration date. And that is the long put strategy, a simple yet effective way to short the market using options.